Hello and welcome to the podcast hosted by myself, Louis Kessinger, and my dad, Tommy. We are a part of the Kessinger Lee Group at Baird and have been serving investors in our area for 4 generations. Our goal is to start a conversation around topics within the world of finance and to educate you, our listeners. All right, welcome back to another episode of Father-Son Finance. Today is going to be a little bit different. We're going to talk about how our team, the Kessinger Lee Group, looks at investing, how we look at companies and strategies and products, and how we employ them for our clients in different ways. So we're pretty excited to break this down for everybody and give you a little look behind the curtain on our process.
Yeah, that sounds great. And I mean, basically, the first thing we do when somebody says, "Hey, I'm interested in working with you," and our favorite question people ask us is, "What do you do?"
Mm-hmm.
Or "What can you do for us?" We start with 2 very important inputs,
Mm-hmm.
right? What's your dollar amount?
Mm-hmm.
People say, "Well, do you all have a minimum?" Well, we don't have a minimum of a dollar amount per se. We do have a minimum in terms of attitude.
Yeah.
So you got to be serious about saving and investing.
Mm-hmm.
This isn't gambling. This isn't, hey, I want to buy some what's hot.
Yeah.
Like that. There are platforms out there. I'm not going to name them. They're all over the place. Online. Feel free. They will rain down, digital confetti on your head, and it's super fun. If that's what you're doing, we are fired up for you.
Yeah.
But what we do is we like to work with people who like us and who are serious about saving and investing. So that means, what's your dollar amount,
Mm-hmm.
and what do you want this money to do?
Yeah.
Industry word, investment objective.
Yeah.
So that's really where we start.
Mm-hmm. And the reason that we start with that, again, your dollar amount could be $100 a month.
Right.
But if you're like, man, I know I need to start saving for retirement, how do I do that? Can you help me?
And we always say, in that case, little stacks make big stacks,
Mm-hmm.
number 1. Number 2, your dollar amount is as important to you as anything.
Mm-hmm.
And interestingly enough, the person who has $100 a month
Mm-hmm.
to start, that $100 may have more significant emotional value to them
Mm-hmm.
than somebody with $10 million. Right?
Absolutely.
Because the person with $10 million they've got a little wiggle room.
Yeah.
They're going to be okay.
Right.
But so your dollar amount is super important to you. And then what do you want it to do? I mean, one of the things we say is, look, money is no different than any other tool. It's no different than this computer.
Mm-hmm.
It will not do anything until you tell it to do something. So we get the investment objective going. Talk about what that is a little bit, Lou.
So the investment objective is, hey, what do you want this money to do? Are you saving for retirement? Are you saving for a kid's college?
New house?
Are you saving for a house? Or do you want to put cash aside so that you can feel safe, that if something were to happen, you have some cash that you can fall back on? And those are just some examples of what your objective can be. But they're going to sort of guide the direction we're going to go in.
Also, what is your past experience?
Mm-hmm.
So we want to know, what was your experience with investing before? Did you have a 401k at work where you were putting money in? Did you buy a stock at some point because your uncle's brother, sister's mother told you that could be something that's good?
Mm-hmm. You got some shares of Starbucks for high school graduation, maybe.
Right.
Something like that.
Who got that?
But so those are the 2 places we start.
Yep.
Because they determine the menu.
Well said.
And so we sort of say, hey, in general, our team, for the most part, the core of our investments are in 3 different strategies. So if you're starting out at $100 a month and you're going to sock some money away, we start with a mutual fund.
Right.
Typically.
Right.
All that is a fund that owns a group of stocks
Pool
all
of investment.
together. And what it allows for is to diversify your money, especially in smaller dollar amounts.
Right.
So if you've got $500, I can't diversify you by owning individual companies.
Right.
Because one stock may be $500, and now your entire portfolio is in one
stock.
company.
Yeah.
And we don't view that as prudent.
Right. So, if you're there, the first stepping stone is a mutual fund, maybe in an IRA, Roth IRA, depends on your situation. Next stop, maybe you've got $5,000 to say $60,000, $70,000, $100,000. We're going to be looking at something called an ETF, an exchange traded fund. This is like a mutual fund, but it trades every day on an exchange that the markets are open, and it gives you direct participation into well-known indexes: the S&P 500, the NASDAQ 100, the Dow Jones Industrial Average, the Barclays Aggregate Bond, or what have you. So we're going to use you're still diversified. You're still taking, dollars that may be important to you, but small relative to the world of trillions of dollars of capital flowing around the planet. And these exchange traded funds, the granddaddy of them all, the S&P 500 SPY, was started in 1993. Yeah. I started my career in 93. So, I kind of know.
So it's an old fund.
So it's an old fund, but it has a tracker. Not recommending it, just telling our listeners, like, that's what an exchange traded fund is, and that they have long track records. Some of them do. Yeah. Some of them are being created as we're doing this podcast on anything you can think of. To your point, you can get sector exposure. You can buy ones that have oil or gold or utilities or only pharmaceutical stocks or no pharmaceutical stocks, or there's it's like going to Baskin Robbins. There's every flavor imaginable. Oh gosh, we don't even don't talk about that. But ETFs is the next.
Yeah, and again,
logical.
very similar in some ways to the mutual funds, but a lot of times less expensive, more tax efficient.
Definitely more tax efficient. We would really use these if it's outside of a retirement type of an account.
Yeah. And so there's your first 2 kind of levels, and we always say, hey, you got 2 graduation days. One is from the mutual funds to the ETFs, and then you get to graduate eventually from the ETFs to individual stock portfolios, and that is where we feel we can add a lot of value.
Yeah, we've got some incredible people that help us with that. We are not sitting around our office like throwing darts at the Wall Street Journal trying to come up with ideas. These are highly targeted growth strategies. They are typically for larger accounts. The biggest sweet spot really starts at the 250,000-ish level. You can do it for a little bit less, but you may not get the diversification you really need as your wealth starts to grow and compound. But these typically have a very specific strategy that we're putting in place, and we'll talk about that in just a minute.
Yeah, so we have, again, 2 individual stock processes that we are, we feel a lot of conviction. We've used for a long time. The strategies themselves have been around for decades, and so, but they are very different from each other, and that's why we have 2 of them. One is a qualitative strategy, and one is a quantitative strategy. And basically, the main difference is, one, the qualitative is based on, the CEO, the management of the company. how does this company separate themselves from the rest of their industry? How are they building that moat to keep competition from coming in and taking away their share? How are they, growing earnings and
do they have a new product?
Yeah, right.
So what's the fundamental reason to own that company?
Right.
Right. So is their balance sheet in order? Is what is it? What is the catalyst?
Yeah. What's the story?
What's the story?
What's the story behind this
and
company?
what's the value? Like, what do we think it's gonna be worth in 3, 5, 10 years? Yes, we do hold stocks longer than 10 minutes.
Yes.
We hold stocks 10, 20, 30 years. We have families that have held positions for literally decades. And sometimes those decades are good and sometimes those decades are tough.
Yeah.
But if it's good business, we hold it.
On the other side is the quantitative strategy. That is a numbers-based. We are looking at ratios. You hear us talk a lot about price to earnings ratios, revenue, but what dividend are they paying? How much are they growing? How fast are they growing?
Let's make a quick a quick sidebar on a quantitative strategy. So you may hear, the listener may hear something called a quant fund.
Yeah.
Now, a quant fund in the normal Wall Street parlance might mean some way of trading stocks at a rapid pace to clip the market for a few pennies. I just get a few pennies of an edge against the rest of the Wall Street, but I do it 1,000,000 times.
Right.
And I create, through all these pennies that we're capturing, a return. It's hard to imagine what your Schedule D would look like from your taxes because your 1099s are going to fill up this room. When we say quantitative strategy, what we mean is we are taking the emotion out. We don't necessarily care what the name of the CEO is. I don't care what you sell. You could sell furniture. You could sell oil.
Yeah.
You could sell technology. You could sell jackets,
to your
eyeglasses.
point, you don't care what the name of the CEO is. You actually don't really care what the name of the company is.
Great point. We don't, and it's important that I don't because I have personal emotional baggage on some of these companies that where I would never have wanted to buy them, and yet they turn out to be great investments. So our quantitative strategy is something that was developed by Baird back in the 80s. We put it on a server in the early 2000s. And we evaluate all these balance sheet and income sheet items, and it gives us a list and ranks these companies, say the S&P 500, from 1 to 500, with 1 being the most undervalued and 500 being the most undervalued, in our opinion.
Yeah.
But again, that strategy is designed to be the polar opposite of the first one.
Right.
But they do work together.
They do. They do work together. And one way to sort of think about it, this is a lot of sort of financial jargon and ratios and all that. But seriously, one way to think about it, there was a piece that was written about this strategy. And if you have ever read or seen the movie Moneyball, and seen how they go through players and they find a relative value.
Right.
And that's the way to think about it, is a relative value.
The other way to think about it is in the book and in the movie, their primary goal was to not get out. Like, do whatever you can to not get out.
Right.
Right? Take the walk. We're not going to steal a base because you could get out.
Right.
We're going to wait to be advanced by the base hitter, by the next guy that gets walked. So that's just a different way of looking at managing the money. And again, we combine the two for your benefit in order to come up with a portfolio that suits your sort of A, emotional needs, but B, financial needs, and maybe in that order.
And So then the beauty of these two strategies and how we always sort of say one zigs when the other zags.
Right.
A lot of times. So you're gonna have one of these, and so to that point, a lot of people have both strategies
in different places in their portfolio.
Right, for different reasons. But they complement each other well because they're sort of set up for different market environments.
And if you've listened to another one of our podcasts, we did sort of the ABCs of all the different accreditations that are out there.
Yeah.
And both of these strategies use what we call chartered financial analysts, CFAs. So our team partners with the CFAs that are part of these strategies. And when I last counted, we have 10 CFAs
that's right.
that work in conjunction with our team to help our clients. We feel the conviction of that because there are literally decades-long track records. Now, just because it happened in the past doesn't mean it's going to happen in the future.
Right.
On the other hand, you start to see how the sausage is made, and you in this case, you get more comfortable with it.
And so these aren't the only strategies that are out there. And
they're the most exciting for us.
But they're also not the only ones that we use. This is the bulk of what we do, but there are so many different things out there, and we are constantly trying to evaluate and educate ourselves because, like you said, we have 10 CFAs as a part of these strategies, researching and working on our behalf, on our clients' behalf, to make sure that these portfolios are in good order. What we also have are CFPs working on a plan to place you in the correct strategies. Because you could have the best strategy in the world, but if it doesn't fit your plan, then it
won't work. Yeah, it won't work. And to your point, we have other strategies that deal with generating income. You've retired. You're no longer getting your paycheck. So you need to get some kind of an income. And so we have strategies for income generation. If you're concerned, markets are at an all-time high, and you're concerned about, I really like the view of my statement. I want to protect my portfolio. We have downside protection strategies that we use, as well as some volatility management tools that can be used.
Yeah, and so that's why we always, we start with what's your dollar amount and what are you trying to do? What is your investment objective? Because then we know what part of the menu we need to start with.
Yeah, exactly. And to your point, that your goal as a client may change. Your first goal may have been to buy a house. Your next goal may be to put your kid through college, and your next goal may be to go through retirement. So there is no one size fits all. There is no set it and forget it. There is no, hey, I'm just going to buy that one stock and, hope that in 50 years it's going to take care of all the things I want. That's not how this works at all.
Yeah. Yeah. We take all of the different inputs, and again, pairing the CFP with the CFA, we feel really, really benefits the client and puts them in a seat to be successful.
Yeah, and I think that's hopefully this gives you a little flavor of when people, what do you do? Well, this is what we do.
Yeah, and we sort of always say, hey, we're pretty vanilla. We have access to a lot of different things, and we may use a lot of different things for different reasons. But in general, we like to own individual companies, and we think that gives the client the most potential for upside. And I'm losing my words here a little bit.
But for accomplishing their goals.
Yeah,
that's the thing, is we believe in owning a piece of the American economy through either a mutual fund, an index ETF or owning that individual equity outright is going to help you grow your wealth to do the things you want to do now and in the future.
Yeah, well said. Thanks for the help there. See y'all.
This podcast is intended for informational and educational purposes only. It is not an offer to buy or sell or solicitation of an offer to buy or sell any security or investment or to participate in any particular trading or investment strategy. The information is considered to be from reliable sources, but its accuracy is not guaranteed. We do not offer legal or tax advice, so please consult your tax or legal professional for information specific to your situation. The opinions expressed are those of the speaker and not necessarily those of Robert W. Baird and Company Incorporated. Please note past performance is not indicative of future results, and diversification does not ensure a profit or protect against loss. All investments carry some level of risk, including loss of principal. You should carefully consider investment objectives and risks of any investment before investing. An investment cannot be made directly in an index. Securities and investment advisory services are offered by Robert W. Baird and Company Incorporated, a registered broker-dealer and investment advisor, member NYSE, FINRA, and SIPC. You should consider the investment objectives, risks, charges, and expenses of each money market fund carefully before investing. This and other information is found in the applicable prospectus for the money market fund. Contact your Baird financial advisor for a prospectus. Please read the prospectus carefully before investing. Money market funds are managed to maintain a stable $1 share price. An investment in a money market fund is not insured or guaranteed by the Federal Deposit Insurance Corporation or any other government agency. Although the fund seeks to preserve the value of your investment at $1 per share, it is possible to lose money by investing in the fund.